So here is everything you need to know about private credit AIFs. So let's break down the term to understand it in a more detailed way. So private credit, when we say private credit, what does it mean? So private credit means that you are lending your money. You are lending your money to a privately held group of companies which are illiquid in nature. You are basically Private credit refers to non-banking lending where institutions or fund directly lend to private companies. The companies are not listed on the public markets and the companies are typically illiquid in nature. What are private credit AIFs? So private credit AIFs are category 2 alternative investment fund registered with SEBI. They invest in typically debt instruments of a privately held companies. And these debt instruments include a senior secured loan, distressed loan, then special situations debt, structured debt, high yield bonds. So these AIS in simple term act as a private lender, often stepping in when traditional banks hesitate due to regulatory or risk limitations. So sometimes bank is hesitating to help these privately held companies, but at that point in time these private credit AIFs help these companies in for example they are looking for growth funding or working capital funding. Then these private credit AIFs help these corporates. So let's understand the key features of private credit AIFs. So target investors generally is high net worth individuals, ultra high net worth individuals, and family offices, corporate offices, which have a decent amount of net worth, and they are looking to have certain good debt exposure in their portfolio. Then the ticket size is 1 crore as per SEBI rules, and the tenure is typically 3 to 7 years hard lock-in, and returns generally range from 10% to 18% depending upon the risk and the strategy that you want to choose. Illiquidity, obviously there is a lot of illiquidity because you cannot take early exit. The fund will take a exit and fund will give you the money back. You cannot yourself take a exit, so illiquidity is always there. Then if we talk about the risk involved in these AIFs, so there is a risk involved, like credit risk is involved, where the credit ratings can be like degraded. Then there is a illiquidity risk, as we have discussed that already. Your money is in a hard lock-in for say 4 years or 5 years down the line, so you won't be able to get back your principal back say till 4 or 5th year. Then there can be default from the borrower, so these kind of risks are always there. So this is a very good product, private credit AIFs, if someone is looking to diversify the portfolio and looking to have a debt exposure. So private credit AIFs offers a unique blend of high yield potential and strategic diversification, ideal for seasoned and experienced investors looking to go beyond the traditional debt instruments. So thank you so much for watching the video. Thanks.